question 3, the question of the last night. Okay, what I want to change in all these, when you get an inheritance, okay, you're not entitled to claim the small gift exemption, okay, for an inheritance. But if it's a gift you get, from someone obviously still alive, then you can claim the small gift exemption. So you just have to take out the €3,000 out of here for the small gift exemption. That's just making our tax just higher.
That was particular because it was inheritance.
That was an inheritance, yeah. That one was an inheritance. And it'd be the same the whole way down along, we're taking out the small gift exemption. So the small gift exemption does apply to a gift, but doesn't apply to an inheritance. So the first one there, it was the Jim, it was her brother. Okay, so it should be 306,850. Sorry, 309,850 multiplied by 33%. This should give us 102,251. Just so you have the proper figures in there when you're going back over them. Everything else is says the exact same.
So you take out all the way down.
Yeah, I just take them out of all the way down. So we have that one out of it. That's 18,000. So the only difference there, because she was in her Group B threshold, she's still underneath it. Okay, so she'll still have no capital acquisition tax.
But you still calculate it to show what she has to carry forward,
Yeah, they actually don't ask you how much to be carried forward. So she would have 31,50 and she actually only got 18,000. So we actually have nothing to change in that one. Then Mike, he disclaimed his inheritance. So there's no CAT. Kevin the friend, okay, we have to get rid of 3,000 out of there. Okay, and take his exemption part out of it.
Can you use the plan?
Sorry?
Can you use the plan so this gift?
Yeah, but you can't use that for the inheritance, but you can use it for a gift. So just take that out of it. So that makes his CAT 13,175. Was that the last one? Well, there's another one below it.
Paul.
There is their brother-in-law, Paul. Okay, that should be 550. 815. So 550. 520665. Right, figure 515. That's 520665 by 33%, giving us 171,819. There's probably something you probably won't forget in the exam. That's the last one, that one. So November 2009, question 1. Okay, the next one as well now. November 2009, question 1 was also an inheritance. So change the partner there. Okay, so let's bring her taxability up to 141545. That's question 1, November 2009. And you know, she had the dwelling house that she got off of him. So the dwelling house was the 400,000. Okay, and she had lived with him for 24 years. So I'll get 141545. Yeah? Here you go, the daughter-in-law, so we get rid of her, gift out of that there, giving us 110. So she was group A, so she was actually exempt because she took the place of her husband. His grandson the same, just change that to the 100,000. And that was exempt from CAT then. And we have the residue here. That is going to be 861,000 minus 225. Bringing us on to 636, so 636, 33% is 209880. That's, who's that? That is Ben. Big Fran. So the 219881? Yeah? Okay, and we have one left. With Ave, there's one here. Or Ave is one I should say. Ours. So she's got 111. 111,000. So she's group A threshold, so she's exempt from CAT.
What I've been doing there is I'm taking away like the 2 to 5 and I'm showing what's
Oh, you show what's left?
carry
Yeah.
forward.
That's grand,
That's
yeah.
okay, then.
Yeah, that's
It's just
fine.
that if I don't do it this way, I won't remember to do it that way.
Oh yeah. So you may as well just get into the habit of doing it. So there's a group A threshold left. Okay, and the next one then is summer 2010, question 1, and he died as well. It was Mark Maloney. Get rid of his 40,000. Get rid of the 3,000 there, leaves him with 40,000. So he's a group A, so he's no capital acquisition tax. As I said, like remember to put in the clawback rules.
there's a few 3,000s.
There's the one for partner N. So hers is changed to 110525.
There's one from Paul. Paul was first, was it?
Yeah, Paul was first. I got him there. So it was 40,000. There's the tree. It was 37. It was actually 40.
Just one.
Yeah, it's just before you have it.
So.
Then we have, the next one was N, partner. So we can get rid of that. So that brings us down to tax of 110525. And we have the next one, which is the 3,000 down there, so that leaves us with 100,000. There's 3,000 and the next one from the holiday home one. That's 350. So 350 minus 225. So it's 41,250 for the last one there, son-in-law Simon. That's all the ones corrected. Okay, so your small gift exemption doesn't apply for inheritances, does apply for gains. So if they had all been people just giving gifts while someone was alive, they could have all claimed the small gift exemption. Okay, so what did you look at? The next one we're going to look at is summer 2009, question 4. Okay, and this is just CGT, okay, and a bit of capital acquisition tax as well. So if you look at your requirements first, it's actually Paul, you said it's question 4? Paul, yeah?
We got to question 3.
Question 4, summer 2009.
One wasting.
He sold his Renault again, is the first one.
Oh, sorry, it's 2 put together.
So we're the first one, you were at the first one there, I'd say. Go back further in.
June 2000.
Yeah, so question 4 on that, and the first
This one
that.
is in November, so is it? Going behind it?
Yeah,
Right. Cheers. Paul.
Paul, yeah, the first one is the Renault again. Okay, so if you look at the requirement first, compute the capital gains tax payable by Paul, okay, for 2014, just to change your year for 14, and the capital acquisition tax payable by Amy for 2014. Okay, so we have capital gains tax for Paul, and we've got capital acquisition tax for Amy. And if no capital gains tax is due from a particular transaction, please state why. Okay? So our first one there on top is, he sold his Renault again on the 1st of March 2014, just change your date, for 12,000. And the car had cost him 25,000 in June 2007. Will there be capital gains tax on that?
No.
No, because it's a wasting chattel and it wasn't used in his business. So there's no capital gains tax. the venom again. It's a wasting chattel, not used for business. Not liable to capital gains tax. Is that big enough? Oh, just make it a bit darker there. Okay, where that had been a vein that he actually had used in the business, then you would be charging capital gains tax on it. So because of it was a wasting chattel not used in the business, not liable to capital gains tax. Okay, our next one, he gave his sister Mary shares in AIB that had cost him $15,000 on the 1st of May 2005, and they now have a value of $2,000 on the 1st of June 2014. Okay, just change that to 2014. So that's the sale of shares. Okay, so it's actually, you can see it's a loss in the sale of shares. So we'll be able to use that loss against any other gains he actually has. So we'll just show the loss to know anyway first.
You don't index it, sure you don't, because,
Yeah, because it's 2005, so indexation stopped in 2002.
but even if there was.
But even if there was, you wouldn't, because indexation cannot increase the loss. Yeah. Okay, so sale of shares. So we've got our proceeds. €2,000. Okay, and we have a cost, 15,000. So that's a loss on the sale. Okay, and he actually sold it to his sister. Would that make any difference? The sister is a connected person, so when you sell something to a connected person, you can't actually claim the loss against your other losses or your other profits. You must actually keep it with the same connected person one. Okay, so say it's a connected person.
So if he sold her something else and he made a gain on it,
He could deduct 13,000 off of that, yeah. Okay, so say it's a connected person cannot utilise this loss against his other gains. Only against gains with the same connected person. Okay, so just to watch the connected person one. Like if he told that to anybody else and it wasn't connected person and he made a loss, then he'd be able to use that against his other gains. It's just because it's connected person rule coming in there. Our next one, Paul owns 80% of ABC Limited, which he has been a full-time working director in since 1985. He decided at 60 years of age he wants to play more golf, so he gave his shares to his daughter Amy on the 1st of October 2014 for $1 million. He owned 8,000 of the 10,000 shares of ABC Limited since incorporation on the 1st of March 1985, when the shares were paid for at a premium of 50%. And the balance sheet of the company is as follows, okay? Paul has been advised that his 80% share in the company is valued at $2,680,000. Okay, so we must work out the capital gains tax payable by Paul and the capital acquisition tax payable by Amy. So you're looking at that, what are you thinking with the capital gains tax for Paul? Retirement relief, yeah, and he's transferring it to a child, so he can actually transfer the whole lot tax-free. Okay, look, no capital gains tax. Okay, so if you want to put down here for this one. Okay, so look at Paul's CGT first. So you're looking at retirement relief. Okay, so you're looking at retirement relief for capital gains tax and business relief, agricultural relief, favourite nephew niece for capital acquisition tax. Okay, so retirement relief. So does he qualify for retirement relief? He's over 55, isn't he? Yeah, so that's one check. Working director. For more than 10 years. What other rule have we got? He has to own more than 25%. 25% of the share capital.
So you have the agency.
Okay, so that's the over 25%, so he qualifies for retirement relief. Don't just write down, CGT retirement relief, over 55, working director, and own over 25% of the share capital. There's just a rule about it's either 5 years or 10 years. Is it non-executive director? Just to make sure we're right. It must be 5 years for one and 10 years for the other.
$22.6.1.
And 6.1 is it? Own them for at least 10 years, that's owning the assets. I'll come back anyway, but there's a 10-year and there's a 5-year. There's one of them is for non-executive, and the other one is for executive or working director. Okay, at the moment we go for working director for more than 10 years. Over 25% is definitely the share capital, and over 55. Okay, and there's a big difference for our age then, between 55 to 65. Okay, there's no restriction. And then over 66, we've got the 3 million restriction.
And when they're doing their transfer, is based on what their balance sheet says their assets are worth.
Yeah.
So if they've always been undervaluing them, then
Yeah, you probably have to get a market value done, at that date. Do you have a balance sheet date? But then you'd have to get someone to value them
as well.
Yeah, because you said they probably have been undervalued going back along.
This is full-time working director.
Yeah, it says full-time working director, but I know there is a rule in there for them. But I'll come back to you. I get it in my notes. Okay, so the 55 to 65, there's no restriction. We are transferring to a child. Okay. time to a child. Okay, and his part of the company is valued 2,680,000. So in either case, if it was over 66, he still qualify for the retirement relief. Okay, so qualifies for retirement relief. Is that okay for that part of it? So for the next part, you're actually asked to do Amy's capital acquisition tax as well. Okay, if you're thinking of Amy's capital acquisition tax, you're thinking of business relief. Okay, and then remember, business relief only applies to the business assets. So you must look inside and see what she's getting to see is there any investments and stuff inside there as well. So if you look at her, what she's getting, the buildings, and you've got investments of 70,000, goodwill, debtors, stock, and you've got creditors. Okay? So there's investments inside there. So those investments automatically won't qualify for capital acquisition tax. So they'll be CAT'd automatically. And she's going to qualify for business relief. Okay, but she's only going to get 90% of it. That means 10% of it is actually going to be for capital acquisition tax. And will it be the 2.6 million, or will it be the 1 million? She's paying him for it. Market value rules apply. Okay?
How do you know 90% and 10%? What's that based on?
That's the business relief. That's automatically what the business relief is. Yeah. Okay, so business relief. Okay, and these are for chargeable business assets only. Investments are exempt. Investments are not included in this. The value of the business she's getting is 2,680. Okay, so 2,680,000. Okay, and we'll have to exclude the investments from that. So if you look at the investments are valued at 70,000, but he only owns 80% of the shares. So 80% of it she'll be getting. Okay, not the full 70,000. Okay, so less the investments. Okay, so it'll be 70,000 by 80%, which is 56,000. So automatically that 56,000 is liable to capital acquisition tax. Which leaves us with 2,624. Okay, so 56,000 is liable to CAT. the 2,624,000, okay, it's going to qualify for business relief. But it's only 90% of it qualifies. Okay, just push. Okay, so that's 262,400 is liable to CAT. Okay, so you have to work out her CAT now on that. Okay, so we have 56,000 and we have 262,400. Okay, so we have 56,000, so that's Amy, CAT, computation 204. So we have the business, 262,400. I've got the investments of 56,000, giving us 318,400. Okay, she can get the small gift exemption here now because it is a gift, not an inheritance. And then we'll apply which band, which group? A threshold group, because she's his daughter. That's a 225,000, isn't it?
Yep.
Which brings us down to 90,400 by 33%. Which means she has a CAT liability of 29,832. Okay, will there be a clawback of that? She was granted for 6 years. Okay, so if you want that underneath it, must hold on, must. Keep the business to avoid clawback. To keep the business for 6 years. Relief.
If she was to sell any part of it, then they'd be able to claw back the portion.
Yeah. And if you sell the whole lot of it and you actually you invested in a new business and start off again, then it wouldn't be, you could actually do that.
Okay.
Yeah, it's there on the bottom of page 31 of your notes if you want to put it down. It has to be replaced by within 1 year. Say you sell it, okay, and you replace it in 1 year, then there'll be no clawback of the relief. And as we go on and see these questions where they're asking you the combination of both, do the CGT and do the CAT as well. Like DAT like is okay, like the two reliefs to think about, like the agricultural relief and the business relief, and then just look at your bands.
Agriculture was just at 50.
Sorry?
Agriculture was a 750,000, was it?
No, that's the CGT, if you were transferring it to a third party. It's 90% for like the business relief, is agricultural relief as well.
Oh, sorry.
Yeah. So our next one is, I think summer 2009, question 3. Have we that done? I think we have that done. We've that done. So yeah, with that one done, summer 2009, question 3. Summer 2009, question 4. We just did there now, wouldn't it? Yeah. So we'll go to summer 2010, question 4. Summer 2010, question 4. And this is another CAT one, but it's an inheritance one this time. Okay, so look at your requirements. Calculate acquisition tax liabilities for each of the above transactions. Okay, Mark Maloney died on the 1st of November 2014. Okay, he left a will outlining the following. To my son Paul, my farm in Mayo, market value 600,000, a mortgage 300,000, livestock on farm.
Did you say question 4?
Question 1, sorry. Sorry
I
guys.
think we got one good.
We're question 4 done.
With question 1 good.
With Mark Maloney there.
Have we that done?
Yeah.
Oh, very good.
That's the one you changed earlier to 3,000.
Oh, very good. So go to question, is there question 4 so?
Yeah.
Yeah, summer 2010.
Sure.
It is Sean, yeah. I said last week's list of questions, like this week's list of questions, to make sure I have them all covered. Okay, so Sean made the following disposals in 2014. Okay, so just look at your requirements. Calculate the capital gains tax and capitalization tax liabilities arising from the above transactions. If no tax is due for a particular transaction, please state why. And you can ignore the annual CGT exemption and the small gift exemption in your calculations. Okay, so we see when we're doing this, there's actually people are paying CAT and someone are paying CGT. Okay, so you actually have an offset for that. I just want to give you a note on the CGT CAT offset. Okay? So this is just question 4. Just a note on CGT CAT offset.
So we write that under the question.
Yeah, or just somewhere where you have it for Joe as a theory note for yourselves as well. Okay, where CGT and CAT arise. Okay, so where CGT and CAT arise on the happening of the same event, CAT legislation provides that the CGT paid may be deducted from the corresponding CAT liability as a credit against the CAT liability. So you've got someone gifting someone to somebody, then one pays CGT and the other person to pay CAT, well, you get a credit for the CGT paid against that CAT. Okay, that's the rule. And then as we have a tax, there's a clawback as well there. Okay, so legislation proposes a clause back on the relief in the event that the beneficiary disposes of the property is subject of the benefit within 2 years of receiving the benefit. So if you claim the CGT against the CAT, and you sell it within a year, or within 2 years, you actually have to pay the extra money.
Even if it's transferred into another business?
Yeah, the same, yeah.
So how's this different? This is a gift more than an inheritance. So
No, this is there are two are like reliefs you get, and you avoid. You pay capital gains tax and on 10% or CAT on 10% of it. But this is where like someone say someone gives me a house, okay, and they pay capital gains tax on the sale of it, and then I pay capital acquisition tax. But say they paid 20,000 worth of capital gains tax, and I owe 50,000 worth of capital acquisition tax. I can take the 50 less the 20 and only pay 30.
And is there an exception to that rule?
No, that's just the 2 year. So if I sold that house within 2 years, then I'd have to pay the extra 20 plus the capital gains tax in on the new sale again. So it's worth holding on to it for the 2 years.
So somebody, oh no, that's...
It doesn't have to be a house, it could be shares, it could be anything, it doesn't have to be a house.
Yeah, no, I was thinking inheritance. I was thinking there's a fellow at home who inherited a farm.
But the inheritance would be different,
Yeah,
because there'd be no capital gains
yeah.
tax on the inheritance, so it'd have to be a CGT one. Because the person who died, well, obviously, is not going to pay capital gains tax.
Yeah. So, well, he got a farm with a house, and he gave the house to one of the other relatives or something, so he would have to pay something else. They paid something on the land, and then they took the house and paid the
tax
portion of tax on the tax.
on that.
Yeah.
So it's a good one to have in there. It's a good one that can actually be asked in the exam as well. You know, and there's actually a question coming up in it. Not sure that this one now is another one where someone got shares and they sold them within 2 years and they claimed the CGT, CAT offset, then they actually had to pay back the money. And there's just another note then, just so you have it inside there. It's spousal exemption. Okay, so it's a note on spousal exemption. Okay, so since 31st of January, okay, since 31st January 1995, all inheritances between spouses can be exempt exempt from CAT. And then since the 31st of January 1990, you don't have to remember the dates now, but it's just there, I might as well write it down. Okay, so since 31st January 1985, all inheritance between spouses have been exempt from CAT, and since January 1990, all gifts between spouses have been exempt from CAT. Okay, just to have those notes there, because they're coming up along in the questions we go along. Okay, so number one, so he made the following disposals, okay, in 2014, just to change your date there. He gave his house in Meath to his sister Nora on the 1st December 2014. Nora had lived in the house with Sean since the 1st of May 2001, when Sean bought the house for 100,000. The market value on the 1st of December 2014 is 300,000. Okay? So that is a house. Okay, and just do the dwelling, I was saying about the dwelling house exemption. So when you actually live with the person giving you the house, okay, you actually don't qualify for the dwelling house exemption. Okay? You actually have to be living there for 3 years by yourself, okay, to qualify for the dwelling house exemption. And then the 3 years come in if you're actually living with someone who, because of old age, and old age talking about over 65 or infirmity, then that does count as getting the exemption from the dwelling house exemption. Okay, so he gave his house in Meath to his sister Nora on the 1st of December. Nora had lived in the house with Sean since the 1st of May 2001, when Sean bought the house for 100,000. The market value on the 1st of December 2014 is 300,000. Okay, so we're looking at calculating the capital gains tax and the capital acquisition tax arising from the above transactions. Okay, so he lived in the house with her since May 2001. So he's lived there the whole time, hasn't he? So we're going to presume it's his principal private residence, so he should qualify for the whole lot being exempt. And they don't apply that, I'm just going to, I don't know why they don't do that in the solution. Like it is, I mean, he's lived there in the house with Sean. They don't say it's any other house, so I think you can presume that it is principal private residence. That's what I do. That's what we do. So if you look at
the solution is wrong.
yeah, if you look at the solution is not, hasn't got that.
We
They
should look
give-
at the solution, doesn't it? Because all calculated to be different.
Yeah, but go back to even 2009, like the principal private residence relief was there. So I'm going to go with principal private residence relief. Okay. So number one is the house in Meath. Okay, Sean lived there since May 2001 up to the date he transferred it, or he gifted it to, what's his sister's name? Nora. Okay, I'm going to presume this is his principal private residence. So we'll pay no means tax as principal private residence PP. so that's the first one, the house in need, CGT for Sean. Okay, the second part of that then is capital acquisition tax for Nora. Okay, so Nora's CAT for Nora. Okay, so the market value is 300,000. So she's presumed to be taking the gift at 300,000. So market value of the house is 300,000. Okay, she won't qualify for the dwelling house exemption because she's lived there with him the whole time. Okay, so she's not going to qualify for that. So she's going to put that in there. Okay, will not qualify. Just so you know the rule that that's there, not qualify for a dwelling house exemption. Okay, so she will not qualify for dwelling house exemption. She's lived with the disowner.
Should they give an extra mark for using that word?
Yeah, that sounds good, doesn't it? Which lived with the disowner. And has not had 3 years. For which the way to word has not lived there for 3 years herself. Has not.
On her own.
Yeah, 3 years on her own. Okay, it's just like, you know, it's, do you know what I mean? It's just showing you know the rule of the 3 years, or the dwelling house exemption.
Maybe he got kicked out by his wife and he had to live there.
Maybe.
And then she took him back in whenever he handed over the house. Went to pay him.
Writing this in
Maybe.
Okay, so the market value of the house is 300,000. Okay, she's his sister, so what one will she come under?
225.
B.
B. It's only the child one is the A. Okay, so we've got threshold B. That's 3175 or 3150.
It says ignore gift, the small gift exemption.
Yeah,
stuff.
yeah.
Should we include it in the purpose of the inclusion?
If you want to put it for your exam, do you know what I mean, for yourselves, but other than that, you've just been told in the exam to ignore it, so you wouldn't be doing it then.
Would they generally tell you not?
They tell you to ignore it, right? And if you don't want to ignore it, do it. So that gives us 269,850 by 33% is 89,051.
She gets no relief off of that because she didn't have anything.
Yeah, whereas if he had paid capital gains tax now on that sale, she would have been able to take the capital gains tax he had paid off of it here.
And that's what they do in actual land, so is it?
Yeah. But you know what, you can't presume that it is his prince because he's lived there since 2001, that's 13 years. Do you know, so it surely is.
And just in case, like on the day, would we do the other way as well?
Just do it, yeah, I can do it all just to have it done. Yeah, so just say, move down, just, okay,
You wouldn't do the other, you just say, assume this is, you hardly have.
So if they make the assumption, 10 marks. Once you make the assumption, they can't mark you wrong.
They
like,
don't specify whether it is.
whether it's principal
But it's a reasonable
residence.
assumption that it is.
Yeah, but if you want to do it away, presume it's not principal private residence, just have the calculation done there as well. So you can see the exempt, the
Or do the calculation first and then just assume.
No, but I just mean just for illustration purposes here.
You wouldn't work out two ways in the exam, right?
No, just do it one. But just so you have it, so you can, in case it did come up, presume not principal private residence. Okay, so you're going to have proceeds. Okay, so our proceeds are the 300,000. Okay, it cost back in, when did he buy it? May 2001. So May 2001 is what tax year? No, just 2001. 2000, you've got the short tax year inside 2001. So it's April to April, 00 to April 01, and then from April to December is the short 9-month tax year. I won't flex, I did my exams for that short tax year. So I had to learn all the tax rules for the short tax year. Okay, so that is 2001, I think it's 1.087. I think it is now.
Still remember.
Well, I do have gain tax for second year, so it's just,
Sounds familiar.
yeah, I think it's 1.087. It's 108,700. That's 191,300. Okay, by 33% was we're ignoring the annual exemption. That is 63,129. Okay, we're presuming it's not the principal private residence.
So that he would have that paid already, so she'd only be paying the 23.
So yeah, if you take go to hers, then you take that 63,129 off of it. Okay, so that's CGT offset. So that's Nora's CGT liability. Is down to 25,922. Okay, and she has to keep the house for 2 years to avoid clawback. Offset. Okay, so like you're showing there, you know the rule for the dwelling house, you know the rule for the offset, and you know what the clawback is as well. So anytime you use a relief, just show what the clawback is too.
So if he was to charge her 163,129, then he'd break even because he's
He's
what is he
taxed.
the same now? Is that the only thing he'd have to do? So if you were doing a forward planning for him, like to say, look, this is what you'd end up paying if it's not your private, if it is your
Principal
or is
private, if it's not a principal
let's
private
say if he only
residence,
wanted to get 100,000 out of it, then he could just sell it to her for the 163. So he sold it to her for 100, but he's paying 63
oh no,
on it.
he sold it to her, he didn't sell it to her for anything. He gave it to her free.
Oh.
The 100,000 was how much he paid for it when he bought it.
Okay.
So I just gifted it to her.
So did they make a mess of that? Like, did they want you to do it that way?
Well, I can't say you can't go wrong when you're presuming that it's
Yeah, but I mean, you'd have that question, or in theory, you'd have that question answered, like, in half the time you could do it.
do the other way. Yeah.
You're probably better off to give them the longer way just in case.
But like you had time shown both ways. Do you know what I mean? You can mark round in, presuming principal private residence, not presuming, because it's not clear from the question whether it is his principal private residence, so it is open to interpretation.
Well, you would make reasonable assumptions, personally.
Yeah. Especially when he has it so long. May 2001. Okay, on the 11th of November 2014, he gave shares in Bank of Ireland that had cost him 20,000 on the 1st of February 1999 and were worth 54,000 on the 11th of November 2014 to conquer cancer. Yeah, it's charity donation, so the charity won't pay any capital acquisition tax, but he will pay capital gains tax on the sale of the shares. Okay, even though he gives them to a charity, he'll still pay capital gains tax. The charity will get them, but the charity will pay no capital acquisition tax. Okay, so the sale of shares. Okay, so we will have Sean liable to CGT. So we've got proceeds of 54,000. Okay, we've got a cost figure in February 99. So February 99 falls into the year 98-99. Okay, 98-99. Is 1.212. Okay, and it costs how much? 20,000. So it's 20,000 multiplied by 1.212. So that is 24,240. Which is a gain of 29,760 by 33%.
So obviously you gave him away, then you turned around.
Yeah, yeah. Okay, and then the charity. Saving the. Okay, and the charity receiving the share liable to no CAT. Okay, then the last one, he gave an antique painting to his friend Mark on the 1st of June 2014. The painting had a market value of 130,000 when Sean inherited the painting on the 1st of March 1984 at a market value of 13,000. Okay, so we're going to be having Mark, we're going to have Sean paying capital gains tax on the sale of the painting, and then Mark paying CAT on the receipt of it. And what group will he be in? C, because he's a friend. Okay, so number 4. Sale of paintings, we've got proceeds of 130,000. And we have cost in March 84. So March 84 falls into the year 83, 84. Yeah, so April 83 to April 84. So 83, 84 is 2.003. And it cost him 13,000. So 26,039 euro. So it gives 103,961 by 33%. So that's 34,307 in capital gains tax for him. CGT for Sean. And then we have CAT for, what's the name of it? Mark. So okay, proceeds 130,000. Okay, you fall into, he's a friend. So group C threshold. And that is 15,075. Okay, and that is by 33%. Okay, then we have our SR CGT offset, and that is 34,307, which makes him have 3,618 of a CAT liability. Okay, and and he was to keep the painting for 2 years to avoid CGT offset.
So you could have actually done the first part of it as principal private residence because you're showing, you know that rule and that.
Yeah,
You're
yeah,
actually showing more than that because you know there's not.
yeah.
So if he sells it within the 2 years, he has to pay.
He has to pay the 34,307 back. Plus then whatever capital gains tax he'd made, he'd have to pay when he sell the painting as well.
Would he be subject to any disabilities on that?
Or if he probably would.
All right.
They would, I'd say, yeah. They'd find the loophole there to get that out of them.
How might they find out that he sold it? So that it's just a.
Well, it's all computerised now, so it's very easy. Do you have to log them all into your...
Kind of barcode and stuff with the antiques like that.
Oh, they would then have some kind of a... Yeah, I don't know, I'd say, yeah.
They'd be sure going to have that kind of a
Like
For
Yes.
30,000 painting, you'd have to have
Should have a
insurance.
serial number, no.
that kind of money changing hands if it's going to bank anything over 15,000 is it 5,000?
Is it 5 to what that they have to show where... Yeah. If you go up to just the question above it, question 3, it's actually an income tax question, but the last paragraph in it there is about the sale of shares. It's question 3 of the same paper. Okay, and just because there is a rights issue with it, just to see it's a rights issue there. So the story with a rights issue is, because shares go on the FIFO basis, okay? So he bought the shares, right? And a couple of years later, there's actually a rights issue, but in the middle he bought more shares as well. Okay, so he bought shares, and then there's a rights issue. Okay, so the original shares that he bought way back, say in 2000, we'll say, you have a rights issue to them, say you get an extra 100 shares. Well, that 100 shares goes back to the original date you bought them, and you sell them before you sell the second lot that you actually bought. That makes sense?
Yeah.
Yeah? Okay? And you only index them up from the date you actually got the rights issue. Okay? So they go back to the original date you bought them.
So they have to be sold first, but you don't actually...
We don't get the indexation going back to the original date. That's for a rights issue. And then if it's a bonus issue, you get a bonus issue for free. Okay, you don't actually pay any money for the bonus issue. And that goes back to the original date as well. But you take the indexation from the date you actually got the bonus. Or there'll actually be no indexation because you got them for free. Okay?
So there's no indexation.
No indexation, because you can't index up 0. Yeah. But the important thing is to take them back to the original date you bought them and do the FIFO based on that then. So if you just...
Is the
Yeah.
solution right?
I didn't actually look at the solution now. No, yeah, they went back and they took the 500, alright, yeah, and took them from the date that they were. Yeah, so it's right, yeah. The difference is that the 25% CGT, whereas we will be using 33% CGT.
Sometimes 25.
Yeah. Okay, so Mark sold 3,750 shares in Silverton Limited on the 16th of December 2014 for 35,000. He had bought 2,000 shares of the shares on the 1st of March 84 for 3,000 and 1,000 of the shares on the 1st of July 1998 for 2,500. Okay, so just put up that there first. Just go in here. Okay, so this is summer 2010. Question 3. Question 3. Shares. Okay, so he purchased them. So if you print the first lot, leave a space, second lot, and leave a space then as well to put in the right issue. Okay, so his purchases. Okay, so we have 2,000 shares on the 1st of March 1984. Okay, and that is for 3,000 euro. Then we have a space, and then 1,000 shares on the 1st of July 98. Okay, he got 1,000 shares for 2,500. Then there was a 1-for-4 rights issue at a price of €2 per share, acquired on the 14th of March 1999, for which Mark fully subscribed. So he got, for every 4 shares he had, he got 1 share. Okay, a 1-for-4 issue. So he had 2,000 shares from 84, so he got a quarter more shares, so 500. And the date for them is the 14th of March 99. And they were for €2 per share, so that is 1,000 euro. Okay, so 1-for-4 is for every 4 shares you have, you get 1 share. So then he got another, he has 1,000 shares now on the 1st of July 98, so 1-for-4 is 250 shares. So 250 at €2 is 500 euro. Okay, so just to show them that, show these 2,000, this 500 being with that 2,000, and then this 250 being with this 1,000. So he's selling 3,750, which is actually the whole lot. But say he was selling only 2, 5, say he was selling 3,000 to them. Okay, even though he got these ones in March 99, because they're related to this one, you take that 2,000, that 500, and 500 out of this. Yeah, if he was selling only 3,000 of them, and you'd leave this 250 and the remaining 500. So when there's a rights issue or a bonus issue, okay, you put them with the date you actually got them. But we're only indexing this one up then from the 14th of March 99, not from 84. Okay, so we've got the sales shares. So we've got proceeds. Now proceeds are 35,000. Okay, so that cost. March 84 is 84, 85, March 98, 90, 83, 84, isn't it? Cost 83, 84. And that is 83, 84. 2.003, yeah. So that would be 2,000. by 2.003. So that's 4,006. Then we've got the cost in the 14th of March 99 is 98.99. 98.99 is 1.212. So 1,000 by 1.212. So then we have a cost in, what's 14th of March 1999? The same one, isn't it? 14th of March. Sorry, I'm on the wrong date. The 1st of July 1998. So July 1998 falls into
multiplying up the shares as opposed to what he.
what he actually paid for them. Sorry, guys. Sorry.
I'm just looking.
Oh, I just said one right. 1,000 by, yeah. I did the first one wrong. I took the wrong figure. I took the shares instead of the, that's why I always put euro signs outside them when I'm doing them. So I won't make that mistake. So the 1st of July 1998 is April 98 to April 99. Yeah, so it's the same one, 1.212. So that is 2,500 by 1.212. And with 500 multiplied by 1.212. That comes to 10,857 from the 35,000. 2414, am I out of my figure?
No. Sorry.
Yeah.
Oh, yeah.
You presume he's no other gain, so take off for an exemption of 1270. That is by 33%. So that is 7548. So the way I wanted to do was like show you that it was the bonus issue to actually, or the rights issue to bring it back and use a FIFO rule like that. So like it doesn't show clear there because if you're selling the whole lot, only if you were selling less than that, it come into play. So it's 8 o'clock, do you want to take 10 minutes there, yeah? We'll come back for more.
seminars on the website? Do they normally hold those?
I'm not sure, no. We'll be doing a revision day here anyway.
Alright.
So,
I have an awful lot to do with it.
I was actually give you I thought I brought with me tonight the corporation tax notes.
Oh yeah.
Yeah. So I'll actually, have you a printer at home?
I have.
If I email them out to you?
Email them to me, yeah.
So you'll have them all then.
And that's the only notes you give out.
I have that notes and too, but I can email them on to you as well.
Yeah.
I have that.
Do please,
Yeah.
yeah. Because rather than press that one. But these are the questions now. This is the level of question we get. Is it?
Yeah. Well, they get maybe a little bit more trickier as we go up to 13 and 14. I just wanted to get the basics right, you know.
Right.
Back here, and I saw there in August or June or May 14 last year, there was 3 questions like this on it.
3 questions.
3 questions based around capital gains tax and capital acquisition tax.
Yeah.
So that's
So
why
did
it's
you
a
give
big.
any tips before then? No.
We asked Richard, they don't give any tips.
Yeah. But how could you bring up 3 questions then?
Well, see, you can have the capital acquisition tax,
Yeah.
a separate question, capital gains tax, and you can have someone incorporating, which we must do yet, incorporating a business.
Section
Yeah.
6 to
Yeah, transferring that.
600 or something like that.
And then there could be one where you have a group. So a
Right.
group of companies together, there's certain rules for that too, so they were all kind of all
Yeah.
asked that last
How
year.
much have you covered now since the beginning? Did I
We've
miss?
all capital corporation tax done and all that, and
that's
this,
it, and this.
and this,
All
yeah.
right, okay,
Yeah.
so I'll go back.
And the corporation tax is alright.
Yeah,
The
yeah.
closed company rules come up a lot.
Right.
Other than
Okay,
that,
so I'll do a
Julie.
couple I do a couple of questions on those. If you have questions on those you've done on that already, on the corporation tax.
Oh yeah, I can give
Will
you.
you email them
I
out
will,
to me in your
yeah.
own time?
No bother.
Yeah.
John is looking for your address, date of birth, and PPS number as well.
Right.
That are
That's fine.
do you, can I take them off you, or do you want to email? Or email on to me tomorrow.
I'll
Like,
email
I can
on.
forward them to him.
Yeah.
It's just to register you, and that you be registered like within job, register you here, and that they when they come to the exams.
Oh yeah,
It'll be all
I'll do
set
that
up.
tomorrow.
Yeah.
Yeah, because I go back to my old PPS number.
Oh,
They
right.
refer back to when I got married.
You've got your
I
husband's
got,
W at the
they
end of
made me
the
give
process.
up my PPS number. Well, that's 28 years ago. And then they made me reactivate it again last year after 27 years.
Jeez. And
So I don't know why they
and
did that.
you should see now is make sure, have you been working like on the
Oh, I've been working on it.
yeah,
Never
to make
stopped
sure that
working.
your PRSI entitlements have gone over, gone
Oh,
back
yeah,
to the
that's another
number,
thing, that's
Yeah.
another thing.
just to make sure that they are.
Honest, actually, yeah.
Because we had a problem, we work with someone
Actually, cool. I'd write to revenue about that, would I?
or no, you have to write to Sligo
Right.
about PRSI, just to make
Right.
sure that they have you under the right
Oh, right,
number.
I drafted
Yeah,
a note to
yeah.
them, yeah, that's something I never thought.
Yeah, no, because we had a problem, we worked with it.
Yeah, but they made me go back. They didn't give me a choice for some
Jeez.
reason 2 years ago. I still joined PSS, like, but I'm not separate or anything, just joined PSS. It was the thought I was or something.
Is still recording away, is it?
Yeah.
I don't know. Oh, here we go.
This will be on